Let's begin with the markets and a pair of strategists with some different takes as we kick off the second half. One is buying the dip in tech. The other says not so fast as he looks at other areas outside the best performing sector this year. Paul Hickey is co-founder of Bespoke Investment Group here on set with us. And Lee Munson is president and CIO at Portfolio Wealth Advisors. Welcome to you both. Paul, I'll start with you.
Good to be here.
What's your read of things today?
So today I think we're seeing a lot of what worked in the last quarter is, not working today, and what didn't work is reversion to the mean trade. Mm-hmm. So I think we saw some, stratospheric runs in certain areas of the tech sector to close out the year, specifically in the memory area and in semiconductors. So I think at that point you got to look, and it's all about an expectations game. Where are expectations now? And I think they've gotten a little bit lofty in those areas.
But I mean, we were saying to you, which sectors do you think are best positioned in all of that? And you've got consumer discretionary and financials and industrials, maybe home builders, but no tech. So you're the guy who's not so sure that leaning into tech right now is the best way to be positioned for the back half of the year?
It depends on your perspective, the shorter term versus the longer term. So this is a tech bull market, AI-driven bull market. So as long as this bull market continues, when we get to the end of the bull market, tech will be higher than it is now. But in the shorter term, as I was talking about these runs that we've had, we're going into earnings season, and earnings estimates have gone up so much this in the weeks leading up to earnings season. So it's very, that sounds great. Raises the expectations bar, and most of that gain in expectations is into the technology sector, and industrials have seen the most upward revisions. So that sets the bar high for those sectors. You see sectors otherwise like consumer discretionary, financials, and healthcare, where expectations and estimates have not been rising nearly as much. So it sets the stage for some upside surprises. And I think the consumer discretionary sector is especially interesting because you have gas prices falling. You have the consumer held up. Retail sales held up during the quarter in the past few months since the war started. And now you have gas prices falling even more. And I think that's going to be a tailwind for the consumer in the short term.
It sounds like the broadening out trade is something that, is not out of the realm of reason, right? But if you take a look, Lee, and I'll go to you for this one here, what the expectations are, the setup, so to speak, for some of these mega cap technology names, it's not good, right? We've seen some real weakness, relatively speaking, in those Mag 7 mega cap tech stocks. Does that then mean maybe that a mean reversion trade could play into those types of names versus the broadening out one at least more dramatically?
You mean the lag 7? I totally agree with you. I think you have to edit. Half my equities, because my clients are retired and everything, are in value indexes. We have sort of a saying around the office, like, if you're going to buy a value stock, buy an ETF. Here's where the best thing is. If you can edit down and just find those little value stocks in the mega tech, you're going to have some success. Think about a couple years ago when nobody wanted Google and we got a double out of it. Right now, I think the most important company in the world is Microsoft. Not because of its size or whatever, is that it is the poster child for proof that we're going from building out $1 trillion highway to who's going to make the next trillion driving on it. So if Microsoft can't deliver and they can't show that Copilot and Azure AI are accelerating that bottom line earnings per share, we've got a lot of problems, because every CEO is going to be looking at Microsoft and saying, if they can't do it, that basically blows a thesis. I think they're going to make it, and I can see productivity really happening here. But you got to edit down. I mean, look at Meta today. They're popping 10% because they're selling off excess capacity. Now, I know investors love that because they're saying, hey, Meta's going to get a return on invested capital, but that's not really what it's about, right? That's still just, the cloud and the build out. You want to look for companies that are going to make it. Or you're dealing with companies like Nike that are just headed for more, new lows because they don't have an AI strategy. Mm-hmm. And let's also move away. When we're talking about chips, it's not about the memory stuff. It's going to be about edge computing. And we might roll our eyes now, but think about 2 years from now, if suddenly we're talking about Honeywell because a third of their earnings come from these little edge computing chips, and that suddenly becomes relevant when we got to get AI off the cloud into our pocket.
Come back to that in just a second, guys. We have a news alert on SpaceX that's moving shares of Qualcomm. Seema Modi with the details. Seema?
Kelly, SpaceX has reportedly developed a prototype for a handset-like device. That's according to Wall Street Journal, quoting sources familiar. The phone would essentially run on a Qualcomm chip. Now, the report says the device is designed to incorporate AI and was shared with a select group of investors, in fact, ahead of its initial public offering just 3 weeks ago. Guys, a move into handsets would certainly underscore SpaceX's attempt to diversify its businesses, right? From rockets, satellites, AI, infrastructure, and now potentially handsets. But again, we're watching Qualcomm shares spike on this potential new product coming to market, guys. Back
Perhaps
to you.
we can also put on the screen shares of the likes of Verizon, T-Mobile, AT&T. They were under some pressure, Seema, as these rumors were circulating kind of end of last week and earlier this week. There's a lot of different players who would be affected by this. The one part that stood out to me as well was this mention that perhaps investors were briefed about this before the IPO.
Yeah, it is interesting. I think especially ahead of that run-up and the company taking sort of a unique path to going public, firming up its IPO price ahead of the listing day and using that time during the roadshow to not just showcase the company's growth story, but also potentially, according to this report, reveal some of the products that could be in the lineup as well.
All right, Seema Modi with the latest there on that one. Thank you very much for that. Paul, I'll toss this to you. The market-moving headlines for the balance of pretty much the last year have been centered around artificial intelligence, space travel, and everything else. This is kind of no exception. Are we still tethered to this idea that the AI/cloud/space exploration trade is going to be the thing that really captures investor attention more than just about anything else in the marketplace?
Yeah, so I mean, I think that's where the big stories are. That's what's been driving all the investment for this bull market. One of the drivers of the economy, primarily in the global economy, has been semiconductors. But there are other stories that we can focus on. That's what we talk about every day. But so investors should look into other places that aren't getting the attention. And I think the stronger consumer, better picture for the consumer going into the second half of the year. We had a guest on earlier who talked about the employment picking up and accelerating. That's going to be a tailwind, and I think you're going to see housing do well. D.R. Horton, I think that's a name to look at going forward through July and through the remainder of the year. They trade for very reasonable valuations. That and Disney as well, 15 times earnings. They're returning capital to shareholders, and they haven't had the big run-ups that all these other stocks have had. So if you have any scintilla of good news for them, it could create a spark.
Scintilla is a great word. That is such a... You also talk, and I think everyone senses this, but we're not quite sure what's going to come from it yet, that the Mag 7, and Lee alluded to this as well, the Mag 7 as a group is not really working as a trade anymore. So I'm curious what direction you think these, in terms of the names, you say you like Amazon and Tesla, but I'm curious what the next kind of leadership group, if it gets a moniker, what would that be?
Yeah, so I mean, you can't, they're not one behemoth anymore. And I think what you have to, like you said, we like Amazon, they're exposed to the consumer, they're exposed to AI, so they're exposed to the entire economy. And if you look at the valuation of the stock, it trades at not much higher than a market multiple these days, which you haven't been able to say for forever in the case of Amazon. So that's a driver going forward that we really like in the mega cap space. We don't like the group necessarily as a whole, but there are individual names, like you said, Amazon and Tesla's a name that we like going forward.
Lee, I'd like to go back to you for this one. We know your view on what's going to happen, and it sounds like you are all in on this kind of mega cap tech Mag 7 rebound trade. I wonder how much of that thesis is based on a kind of more constructive macro, bigger picture backdrop. We still have at least a conflict in Iran going on that's looking to be resolved. Oil prices are still a variable right now. Interest rates are a big part of the tech story overall. How does all that square with your pick of the Mag 7 tech trade as the leaders in the second half?
So when you're building that portfolio out, and then you go a mile wide and inch thick on value, which is kind of where my mind is. And then you sort of snipe these little things like a Microsoft, like a Google, like an Amazon. You have to remember, those are still considered long duration plays about all this earnings that's going to be in the future because of productivity and accelerating into the future. So when I'm doing that, I'm also marrying. I mean, I'm structurally short oil with a big hunkin' supply of 30-year treasuries on my books right now. So I still think there's a place while we have this conflict, while I love seeing, rates come down, the oil prices come down and me make money on my 30-year, I still think that through the course of this summer, we're going to see a flare-up. We're going to see a flare-up in inflation, and I think that that's going to give you that buying opportunity to buy what we call long-duration assets. It used to be the NASDAQ. I would say don't just go be reaching for the NASDAQ 100. If you're going to play in that game, you got to edit down to a couple names. And that's why I think Paul makes a great point that I just also want to, reflect is that core, if you're going to buy core holdings right now, especially in an ETF, look at the Russell 1000, look at small cap value, right? And then when you want to go pick a big name, pick a beat up value oriented lag 7 name. But just remember, don't buy it all at once. You see oil go to 90, those names are going to sell off again.
All right. Thank you very much for the conversation. A big one for sure. Paul Hickey of Bespoke Investment Group, also Lee Munson of Portfolio Wealth Advisors.